Good afternoon. This is Larry Tentarelli with today's edition of Your Daily 5 for StockCharts.com. We'll get started with a brief introduction. My website is bluechipdaily.com. You can find me on Twitter. My call sign is at LMT978, the web address Blue Chip Daily. So we'll start with 5 charts that are highest on my watch list today. I've got positions in a few of these, and some are on watch right now. So what I want to do is start from the top down and talk about just 2 of the indices. So we're going to start with the Dow Industrials, and then we're going to take a look at QQQ. So I've got a position in DIA recently started, and I'm seeing a pretty big divergence, especially in relative strength and overall technicals favoring the Dow. So if we take a look at the chart, we can see obviously put in a recent low with the rest of the indices on October 13, right after the CPI number came out. Very, very sharp high volume reversal that day in DIA. We can see a very big reversal bar. Then it's been drifting higher since there. But what I like about this, not only is it leading on a relative strength basis, but the ETF recently reclaimed the 200-day moving average, which is a key sign. Now, obviously, it's pulled back so far this week. This has been a choppy week. We had the Fed meeting on Wednesday. That created a lot of volatility. We've had some earnings, but overall, on a relative basis and on an absolute basis, this is my favorite index by far, much more so than QQQ, much more so than the S&P 500. And I think the key thing, what I'm seeing in these charts right now, and I know there's been a lot of talk about it on social media, a lot of talk in the financial media, but there is a pretty big divergence between tech stocks and growth stocks, and then everything else. So with DIA, from an index perspective, this is the leader by far of the majors. So now if we go down to QQQ, totally different picture. So same thing, it did have a very high volume reversal bar also after CPI. But if we take a look at QQQ right now, it recently failed below the declining 50-day moving average. It's just a few dollars over the recent lows. So if you remember, the Dow Industrials was up here over the 200-day and just pulling back. So there's a very wide spread. A lot of these tech charts like Amazon, Microsoft, Google, they've been pretty much in free fall mode. But I continue to think that QQQ, just based on the chart, really until it can start to get over 295, which is above the 50-day and the 100-day, until QQQ starts to get over 295, I expect that it could be a relative laggard. Now, this doesn't rule out very sharp counter trend rallies along the way, but from a trend perspective, QQQ is the weakest of the 3 indices, and it's something that I'm still avoiding right now. So on the upside, our top ranked sector, and this has been our top ranked sector for most of the year, is the energy sector. So XOP is the oil and gas exploration ETF. So high volume. It's very similar to XLE. The difference is XLE has about 40% of the ETF is in 2 stocks, Exxon and Chevron, and those have been 2 very, very good, strong stocks. XOP has not fully broken out as of yet, but it's just starting to look to break out of this base. So it does have Exxon, it does have Chevron, but it has those stocks in 2 to 3 percentage increments. So it's a little more volatile because it's got some small caps and some mid caps in there, but a very nice uptrend. We can see it's over all 4 moving averages, rising 20-day, rising 50-day, rising 200-day. Sharp shakeout in the summertime, sharp shakeout in September. I do think that OPEC put some type of a floor in the crude oil market right now with their supply cut. So XOP, I think, is set up fine exactly where it is, and it looks like it's just getting ready to break out in the strongest sector in the market of the 11 S&P sectors. Along those lines, we'll take a look at two single stocks. So Occidental Petroleum, Oxy, I do have a long position in Occidental. So we can see same thing. Now, keep in mind, Oxy through the entire summertime and in a lot of volatility in the crude oil market, in the equity markets, Oxy never lost this rising 200-day moving average. So while the indices, we just looked at triple Q all the way down here, and Occidental still has held that rising 200-day moving average. Very wide base. It's very, very close to a potential breakout level. Now, it's important to remember that Occidental reports earnings next week. So people need to decide, do they want to hold stocks into earnings? Do they want to buy stocks into earnings? I plan to hold my position. I don't know that I would take a new position 2 days ahead of earnings, but I plan to hold the position very, very close to a potential breakout. So we'll see if it can get a nice base breakout from here. Low valuation, and energy continues to work. We just looked at the XOP chart, and what I want to do here is try to spend as much of my time focused on charts that are trending higher, because these counter trend rallies, while they can be very sharp when they work, it's been a very choppy market for that. And then the last chart, we're going to stay with uptrends, and we're going to stay in the healthcare sector here. So Eli Lilly, this is a chart that I've shared a few times over the course of this year. They're a leader in the healthcare sector, $343 billion market cap, pays a nice dividend. But the key thing with Eli Lilly is we can see it's got a very nice base breakout. So if we take a look at this base, we'll call 295 the low side, and then we'll call 335 to 340 the high side of the base. And we can see Lilly just pulled back to the 20-day. It's been holding this 20-day higher. They just reported earnings this week. It pulled back to the 20-day. And I think this was the day also of the FOMC meeting. So holding the rising 20-day, 4 rising moving averages overall, very close to a potential breakout. And if we call 335 to 340 this support range, it just has a nice breakout above that. And I think in this market, what my view here, especially after what the Fed said on Wednesday about keeping rates higher and maybe for longer, is my view here is that as long as we're still really in the crux of this tightening cycle, then I expect what's been working to continue working, and what hasn't been working to continue to not work until we get through this tightening cycle. So this healthcare sector, it's been working all year. Obviously, it's got some volatility. Everything's volatile this year. It's been working all year, very close to breaking out to new highs on the chart. It's a defensive sector, and even if the economy slows, and there's a lot of concern about that, the healthcare is a defensive sector that does tend to do well in a variety of market environments. So that's it for today's video. I hope that you enjoyed the content, and I hope that you have a great weekend. Thank you.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.